Welcome to the channel. Here, we provide clear, actionable insights into the complex world of tax and accounting to help your business thrive.
All right, let's dive into a really fascinating corner of the financial world. We're going to look at how two different accounting rulebooks can take the exact same company and paint two completely different pictures of its reality. It all kicks off with a puzzle. So here's the question. Could you have two companies that are perfect clones? I mean, same assets, same business, same everything. But when you look at their financial reports, the numbers are worlds apart. How on earth is that possible? Well, the secret isn't some kind of financial magic. It's accounting. Specifically, it's the massive difference between US GAAP, that's the rulebook used in the States, and IFRS, the international standard. And today, we're going to focus on how they decide who gets to be in a company's financial family portrait. Okay, first up, let's talk about defining financial control. This is the absolute core of it all. It's about asking who's actually in charge here, because the answer to that determines whose assets and liabilities end up on your balance sheet. And right out of the gate, you can see how different their approaches are. US GAAP has this kind of two-track mind. First, you have to run a company through what's called the variable interest entity, or VIE model. If it doesn't fit that, then you fall back to the more traditional voting model. IFRS, on the other hand, it just has one single, unified model for everything. No special side doors. So with US GAAP, it's really a procedural journey, like a flowchart. Step 1, is this thing a VIE? If the answer is yes, then you move to step 2, who has the power and who gets the financial upside or downside. If the answer is no, okay, then you pop over to the other flowchart, the voting interest model. It's very, very structured. And here's the contrast. IFRS throws out that step-by-step checklist. Instead, it just asks 3 fundamental questions. 1, do you have power over the other company? 2, are you exposed to its financial swings? And 3, can you actually use your power to influence those swings? You see, it's not about following a rigid path. It's about the economic substance of the relationship. Now, that principles-based thinking in IFRS opens the door to concepts like this one, de facto control. This is the idea that you can have real, practical control over a company even if you don't own more than 50% of the voting stock. It's about what you can do, not just what you own on paper. And this is maybe one of the clearest dividing lines between the two. Under IFRS, de facto control is a very real thing that accountants have to consider. But under US GAAP, nope. The concept just doesn't exist. You either meet the specific rules-based definition of control, or you don't. It's a hard yes from IFRS and a firm no from GAAP. And the list goes on. Take potential voting rights. Like options, IFRS says you should consider them if they're exercisable right now. GAAP, generally, no. Or how about accounting policies? IFRS requires everyone in the corporate group to be on the same page, while GAAP has exceptions. And spin-offs are a big one. GAAP sticks with historical cost, but IFRS revalues them at fair value. Each of these little forks in the road can lead to a completely different destination on the financial statements. Okay, let's switch gears a bit. What if you don't have outright control, but you're still a major player? You're like the influential cousin in the family business. You don't run the show, but when you talk, people listen. That's where we get into the equity method. And right away, we see another philosophical split. US GAAP is super specific here. It says you can only use the equity method for investments in common stock or something that acts almost exactly like common stock. IFRS, on the other hand, is way broader. It basically says, look, if you have significant influence, we don't really care how you got it, what type of stock, what kind of note, you're using the equity method. So let's play this out. You've got this investment, you have influence, but then the company starts losing money. A lot of money. In fact, it loses more money than your entire initial investment. What do the rule books say you should do now? You guessed it, they say different things. IFRS is pretty cut and dried. You only recognize losses beyond your investment if you're legally on the hook for them. But US GAAP has this really unique clause. It says you might have to recognize those extra losses, but only if you're sure there's an imminent return to profitable operations. That introduces a huge amount of judgment and prediction that you just don't see in IFRS. And there are even more little distinctions that create big impacts. Again, IFRS demands uniform accounting policies. GAAP doesn't, usually. Or check out what happens if you buy an investment for less than it's worth. With IFRS, that gain hits your income statement right away. With GAAP, it just reduces the cost of your investment. So one set of books shows a profit, the other doesn't. all from the same transaction. Look, I know this can get pretty technical, but there's a reason we're going through it. Why should anyone who isn't an accountant care about any of this? Well, because these differences have massive, real-world consequences. And this quote just nails it. Everything we've talked about, the VEs, de facto control, how you recognize losses, it all points back to this. We're not just looking at two different sets of rules, we're looking at two entirely different philosophies about what a financial report is supposed to be. And here's the divide in a nutshell. US GAAP is, by nature, more rules-based. It's prescriptive. It tries to give you a specific rule for every situation. IFRS is more principles-based. It gives you a framework of core ideas and trusts professionals to use their judgment. You could say one is a detailed roadmap, and the other is a compass and a destination. And this is the so what. A company using IFRS might have to consolidate a subsidiary that a GAAP company wouldn't, which could totally change how much debt you see on its balance sheet. This makes cross-border mergers a nightmare, it directly impacts company valuations, and it makes life incredibly difficult for analysts who are just trying to compare a company in New York to one in Berlin. So all of this naturally leads to a really big question about the future. As our financial world gets smaller and more connected, the friction between these two massive systems is only going to become more and more important. So I'll leave you with this thought. As we move forward, which philosophy is going to win out? Are we headed towards a future with one giant detailed rulebook that covers every possibility? Or will we lean on a core set of guiding principles that require more judgment? The answer to that is going to define financial reality for years to come. Thanks for digging into this with me today.